Ladies and gentlemen, today I want to talk about something far more than a fleeting rally. I want to talk about a structural shift in one of the most overlooked assets of our era, silver. The world is standing at the intersection of scarcity and exponential demand, and silver sits right at that crossroads. When markets talk about tight supply, they often refer to cyclical fluctuations, but what we are witnessing in silver today is structural. This isn't about temporary shortages or geopolitical interruptions. It's about a long-term mismatch between what we can mine and what we increasingly need to power the technologies of the future. Silver's supply story begins deep in the Earth's crust, but its demand story stretches across solar farms, electric vehicles, semiconductor fabrication, and data infrastructure. For years, production has stagnated, largely because silver is rarely mined on its own. It's extracted as a byproduct from lead, zinc, and copper mining. When those industries slow down as they have in recent years due to environmental constraints and lower profitability, silver supply becomes collateral damage. That's the first structural fault line. We simply aren't producing enough to match what the new economy requires. At the same time, demand is evolving at an extraordinary pace. Silver's unmatched conductivity and reflectivity make it indispensable for the electrification and digital transformation trends that define our age. In 2024, global solar installations broke new records, and every panel requires between 15 and 25 grams of silver. Multiply that by millions of installations, and you begin to understand the scale of industrial consumption that is reshaping the market. Electric vehicles, too, are voracious consumers of silver, not just in wiring and connectors, but in batteries and charging systems that depend on high-efficiency electrical transfer. What's particularly striking is how this demand growth isn't cyclical, it's exponential. Each new technological leap builds upon the last. As energy transitions accelerate and artificial intelligence drives data center expansion, silver becomes an irreplaceable input. There's no scalable substitute that offers the same conductivity and durability at similar cost. Once you combine this technological inevitability with an inelastic supply base, you get a setup that historically precedes a price breakout. The world has been lulled into complacency by decades of cheap silver. Investors and manufacturers alike assumed the metal would always be abundant, but global inventories are quietly depleting, and major exchanges have reported declining warehouse stocks for months. The structural deficit is no longer theoretical, it's visible in the data. In 2023, the Silver Institute estimated a deficit exceeding 250 million ounces, one of the largest in modern history. That gap hasn't closed. If anything, it's widening as solar ebbs and digital hardware scale at unprecedented rates. We are entering an era where the marginal ounce of silver will command a premium not just for speculative reasons, but for industrial survival. Manufacturers that depend on it are already beginning to hedge and secure long-term contracts. This is a crucial signal. When the users of a commodity start acting like investors locking in future supply to avoid price risk, that's a sign of deep structural stress. Silver is more than a commodity now. It's a cornerstone of the energy and data revolutions. As decarbonization accelerates, every watt of clean energy and every byte of digital information will rely in part on this metal. Yet production growth cannot match this rising curve of demand without significant new investment, exploration, and technological innovation in mining. And those transitions take years, not months. So, while traditional analysts debate the next short-term move in silver's price, the bigger story is already written in the structural foundations of supply and demand. We are moving into a decade where scarcity meets necessity, and necessity drives transformation. Silver's future will not be defined by speculation alone, but by the very real industrial hunger of a world shifting toward clean energy, electrification, and advanced computation, a world that simply cannot function without it. When history turns uncertain, markets begin to rediscover the assets that hold true value, those that can outlast policy shifts, inflation cycles, and currency debasement. Silver, often underestimated in this equation, is quietly reemerging as one of the most powerful safe haven assets of our time. The monetary and macroeconomic forces now converging are not coincidental. They form a precise alignment that strengthens silver's role as both a store of value and a beneficiary of global realignment. We are living through an era of extraordinary monetary experimentation. Over the last decade, global central banks have printed, paused, and then printed again. Liquidity injections and quantitative easing have kept markets afloat, but eroded the purchasing power of fiat currencies. Inflation, once deemed transitory, has proven far more persistent, and now, as growth slows and debt levels soar, policymakers are preparing for rate cuts and renewed stimulus. This is the exact inflection point where investors begin to reprice the meaning of money itself, and where silver starts to shine. Unlike most financial instruments, silver carries a dual identity. It is both a tangible monetary metal and an industrial necessity. This duality gives it an advantage during monetary turning points, when real interest rates fall as they are expected to over the next several quarters. Non-yielding assets like silver gain appeal. The opportunity cost of holding precious metals decreases, and investors shift from paper promises to tangible stores of value. Moreover, silver's correlation with inflation expectations is strengthening. Historically, silver responds later than gold to inflationary signals, but tends to outperform once momentum builds. This lag can deceive traditional investors, but it also provides a unique window for those who recognize the underlying macro shifts before they become consensus. The recent wave of central bank buying in gold is evidence that the monetary system itself is questioning its foundations. Silver is the natural extension of that movement, a parallel hedge, accessible to the broader public and increasingly viewed as a form of decentralized financial insurance. The alignment of safe haven dynamics is further reinforced by geopolitical instability. As global trade fractures and supply chains decouple, currencies tied to excessive debt issuance face increasing skepticism. Investors are diversifying away from dollar dominance, and the search for alternative hedges intensifies. Silver, priced in fiat but valued in scarcity, offers that bridge between traditional capital markets and real assets. In emerging economies, particularly across Asia and the Middle East, we are seeing renewed retail accumulation of silver, a quiet but powerful trend that reflects both distrust in fiat and a desire for autonomy in wealth preservation. The modern safe haven narrative is also being reshaped by technology and transparency. Digital trading platforms, tokenized commodities, and decentralized asset ownership are making silver more accessible to global investors than ever before. This democratization is crucial. It mirrors the same forces that disrupted legacy financial systems and made innovation unstoppable. When access expands, adoption accelerates. Silver's reawakening as a monetary metal is being amplified by this very infrastructure of financial inclusion. What is remarkable about this moment is that all the traditional triggers, inflation, rate cuts, currency debasement, and geopolitical risk, are occurring simultaneously. Historically, each of these factors alone has been enough to send precious metals higher. Together, they create a convergence that could redefine valuations for years to come. The markets are beginning to price this alignment, but the revaluation is only in its early stages. We are witnessing the reassertion of trust in tangible value. Silver, often dismissed as gold's shadow, may become one of the clearest expressions of monetary realism in a system stretched by debt and uncertainty. When capital seeks refuge, it seeks assets that cannot be printed, manipulated, or defaulted upon. That's the quiet power behind this alignment. It's not fear driven, it's logic driven. In an age where digital and real economies are colliding, silver stands as both the bridge and the ballast, a timeless hedge in a rapidly changing world. Every market cycle hides an imbalance, a distortion that quietly builds until it becomes impossible to ignore. Today, that distortion is visible in the historic divergence between gold and silver. The ratio between the two metals, which historically averaged around 50 to 60 ounces of silver for every ounce of gold, now hovers at levels near 85 or higher. This is not a signal of strength in gold. It's a flashing beacon of undervaluation in silver. When these ratios stretch to extremes, they rarely stay there. They snap back, often violently, and when they do, silver tends to lead the next phase of the precious metals cycle. To understand why this matters, we must think beyond short-term charts and price action. Gold and silver share similar monetary DNA, yet they behave differently because of their industrial utility and liquidity dynamics. Gold is hoarded, silver is consumed. Gold sits in vaults, silver disappears into solar panels, electric vehicles, and electronics, rarely to be recycled economically. That consumption pattern means the worlds above ground silver stock is shrinking even as new demand accelerates. Meanwhile, investors continue to price silver as though it remains abundant. This mispricing is where opportunity resides. The ratio between gold and silver is more than a curiosity. It's a reflection of perception versus reality. When uncertainty rises, capital rushes to gold first. It's the default safe haven. But as the macro cycle evolves, and as investors recognize that silver offers both defensive and industrial exposure, the flow broadens. Historically, once gold establishes its uptrend, silver follows and then outperforms. In the 1970s, during an inflationary cycle similar to what we're experiencing now, silver rose more than 700%, while gold climbed roughly 350%. The same pattern appeared during the 2010 rally, when silver's move was nearly twice as strong as gold's. These are not coincidences, they're the mathematical consequence of reversion in valuation ratios. The undervaluation also carries a psychological component. Markets often underestimate assets that don't command immediate attention or institutional endorsement. Gold is institutionalized. Silver remains decentralized, retailed, driven, and somewhat forgotten by large financial players. But that also means it's less crowded. The capital rotation into silver typically begins quietly, first from contrarian investors, then from momentum-driven funds once the price starts confirming the shift. When this happens, liquidity floods into a relatively small market. And because silver's total market capitalization is a fraction of gold's, even modest inflows can cause disproportionately large price reactions. That's why silver rallies are often explosive rather than gradual. Another overlooked dynamic is how technology and sustainability trends will reinforce silver's undervaluation. The push toward renewable energy and electrification is accelerating, and silver's industrial importance is foundational to both. As the world transitions away from fossil fuels, the materials that enable this transition are being revalued: copper, lithium, nickel, yet silver has lagged behind despite being central to solar and EV growth. That disconnect will not persist indefinitely. Industrial users cannot function without reliable access to silver, and when supply shortages emerge, price discovery becomes brutally efficient. In macro terms, this undervaluation is not just a chart anomaly, it's a reflection of complacency. Markets still assume the monetary system will hold steady, that inflation will remain manageable, and that supply chains will self-correct, but those assumptions are weakening. In that environment, gold's rise becomes the early warning, and silver's acceleration becomes confirmation that the monetary narrative is shifting. When the gold, Silver ratio contracts as it inevitably does, it often does so fast, compressing years of underperformance into months of outperformance. The story unfolding here is one of asymmetry. The downside in silver is limited by structural demand and constrained supply, while the upside is magnified by valuation distortions and macro alignment. This is how long-term wealth inflection points are formed quietly in the background, while the majority remains anchored to outdated narratives. The undervaluation relative to gold is not a coincidence. It's an opportunity rooted in market inertia. When that inertia breaks, it will not just be a rally, it will be a re-rating of what silver represents in the new financial and industrial order. Every transformative opportunity comes with friction, and silver is no exception. For all its promise as a monetary and industrial asset, silver carries a temperament that reflects the turbulence of the system it mirrors. It moves fast, overshoots often, and tests conviction at every turn. Volatility is not an accident in this market. It is the natural expression of an asset that sits at the crossroads of monetary policy, industrial innovation, and investor psychology. Understanding that volatility is not a flaw, but a feature, is essential to navigating the silver cycle intelligently. Silver's dual identity, both an industrial metal and a store of value, is what makes it uniquely powerful, but also uniquely vulnerable to macro headwinds. When global growth accelerates, industrial demand supports prices. But when economic slowdowns arrive, industrial consumption contracts while investors retreat into liquidity. The same property that gives silver explosive upside during expansions exposes it to sharper drawdowns during contractions. In essence, silver's volatility reflects the rhythm of the global economy itself, amplifying its highs and lows with precision. One of the most significant headwinds silver faces is the strength of the U.S. dollar. Because silver is priced globally in dollars, any surge in the currency tends to pressure prices. When interest rates rise or real yields turn positive, capital often rotates back into dollar-denominated assets, weakening the case for holding non-yielding metals. This dynamic has been particularly evident during the last tightening cycle. As central banks raised rates to combat inflation, silver's price momentum was capped even as physical demand remained strong. It's a reminder that in financial markets, sentiment often moves faster than fundamentals. Monetary policy uncertainty adds another layer of risk. Silver thrives on falling real rates and liquidity expansion, but it struggles in environments of policy whiplash when investors can't discern whether the next move will be easing or tightening. The path forward for interest rates, inflation, and currency policy is rarely linear, and during these transitions, volatility in silver often spikes. Those who mistake that volatility for weakness tend to exit too early. Those who understand it as part of the structural reset learn to use it as an entry point. Another macro risk is linked to silver's production profile. Because most silver is mined as a byproduct of other metals like copper, zinc, and lead, its supply isn't easily scaled in response to higher prices. That inflexibility can create sudden price surges followed by equally sharp corrections when industrial or speculative demand pulls back. The lack of dedicated silver mining infrastructure means that even small disruptions in broader mining output can ripple through global supply chains. That's opportunity and fragility intertwined, a characteristic of every emerging asset during transitional eras. Then there's the behavioral component. Silver attracts passionate investors, and that intensity can both fuel and destabilize markets. Retail enthusiasm can accelerate rallies, but speculative excess often invites correction. In 2021, for example, social media-driven buying briefly lifted silver prices but quickly reversed when institutional resistance met retail momentum. This dynamic underscores a broader truth. Silver's volatility is as much emotional as it is structural. It's a mirror of conviction, fear, and timing all compressed into a single chart. Industrial risk is another factor often underestimated. Silver's growing role in solar, EVs, and electronics is a double-edged sword. In a global recession, manufacturing output can fall sharply, leading to temporary demand destruction. Even if long-term fundamentals remain strong, short-term demand fluctuations can trigger pronounced price swings. The transition to green technology is accelerating, but it's not immune to cyclical pauses. Each pause tests the resilience of investors who see silver's potential as structural rather than speculative. Finally, market manipulation and paper derivatives remain persistent challenges. Silver's futures market is deep and heavily leveraged, often allowing large players to suppress or amplify price action with relatively small amounts of capital. This distortion can create disconnects between physical demand and market pricing, a source of frustration for long-term holders, but also a potential catalyst once physical constraints override synthetic influence. The truth is, volatility and headwinds are not reasons to avoid silver. They are reminders that conviction requires clarity. Every wave of disruption carries temporary pain before structural change asserts itself. Those who can differentiate noise from signal, who can see volatility as a byproduct of transformation rather than a threat to it, will not merely endure these cycles, they'll benefit from them. Silver's path has never been smooth, but neither has the path of innovation, and in both, volatility often precedes acceleration.